Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments and subscribers. I greatly appreciate it. This week up, we're going to talk about Campbell Soup. It's about that time of year. Winter's coming up. Let's dig into a soup company, especially with inflation fears rising, market at an all-time high. Maybe it's time to go dive into the old classic value stock. Let's dust off Campbell Soup and see how much cash it generates, what it's currently valued at, what we think we can make by owning this stock for a long term as a rational, cash flow hungry investor. You ready? Let's get to work. Now, before we dive into Campbell Soup, we want to take a look at the 5 key attributes that we use to evaluate each stock that we review here in this channel. And those 5 are, number 1, top line revenue growth. We've got to have it. Number 2, earnings growth. We use EBITDA as the enterprise level earnings. That needs to be growing. I want to see strong free cash flow, low debt. Low debt's less than 3 times debt to EBITDA, and we want a well-priced stock. 5 is the well-priced, probably the hallmark of all valuations. You can't pay too much for a growth stock, so we look at well-priced being a market multiple that produces a above-market IRR when we make our investment over a 10-year time frame. That's how we define a well-priced security. We want to beat the market. That's what we're trying to do. Well-priced means you buy a great company at a phenomenal price. Now, I want to remind everybody that I'm currently publishing the one-pagers on stocks. So this is what I'm going to review over time. It's up on our website, cashflowinvestingpro.com. Check that out. I also have a course there where I teach you how to do fundamental analysis. Definitely check it out. You can also find this one-pager for the Cash Flow Investor Club members. I release it before this video. All right, let's dive into the 10K. Now, behind me is the annual report, aka 10K. Annual report basically has color photos and glossy information up front, and the 10K right behind it. 10K, what is that? That is the annual report that all publicly traded companies here in the US release annually. You can find them at the SEC's webpage. They have a search. You punch in Campbell Soup, ticker CPB. You look for 10K. Bingo, you get about 10 years of data right there at your fingertips. Grab a scotch, print it out, highlight, mark it up. I suggest you read all of them for every stock you have in your portfolio. Hopefully that limits your portfolio to a focused number of highly cash flowing, profitable companies you can hold for a long term. But enough about that. Let's go through this Campbell Soup annual review. So behind me is the annual report, the annual income statement for Campbell Soup. Fiscal year ending for the company is July 31st. You got 52 weeks in this period, 53 just because of the week count. That's the way they end up stating it. But essentially it's a full year ending July 31st of that particular year. Net sales, $8.5 billion, 8.7, 8.1. So they're getting a COVID lift here and kind of coming down as the economy reopens. So their revenue's fairly consistent, and it looks like weak top line growth. That's what I would say just on these. We'll look at our full numbers here in a second. But let's scroll down the P&L. We're going to come to earnings before interest and tax. They've done most of the work for you. That's called EBIT, by the way, E-B-I-T, EBIT, earnings before interest and tax. $779 million, $1.1 billion, $1.5 billion. Good for them, guys. Good little boost there. So you got this other income expense. I'd probably add that back if I'm going to get EBITDA, get that out of there. That happens to be an adjustment for pension liabilities. We'll come to that in a second. But that's actually income. That's why it's in brackets, so it's lifting this number a little bit. But it looks overall to me, it's positive, it's growing, although weak. Let's go through and look at the cash flow statement. All right, behind me is the cash flow statement for Campbell Soup. And a reminder that the cash flow statement has 3 components to it: the operating, the investing, and the financing. This top third is your operating cash flow. You want to focus on this line here, net proceeds from operating activities. $1 billion, $1.4 billion, $1.4 billion. I will note that this here is a reduction in cash of $267 billion. So this number's lower by 267. That if you lift this number, it puts it on par with last year. So I think the cash flow from operations is representative of the EBIT that we saw earlier, positive, slightly growing. I scroll down, middle third, I get the cash flow investing. This is where you're going to see any acquisitions that they make, CapEx, which is their capital investment that we want to know, and you're going to see purchase of property, plant, assets, $275 million, $299 million, and $385 million. So slight decline here, but what I want to show you is the difference between here and here. Look, $1 billion of cash, hard money that they made selling Campbell Soup, Goldfish Crackers, Prego. They had $1 billion of cash in the bank. What do they have to peel off to reinvest in the business? $275 million. That's nothing. There you go. I have over $800 million of cash left over at the end of the day. What do I have to do with it? I have to pay debt, and that's it. So we're going to scroll down. We're going to see what kind of debt they had. Now, short-term borrowing and repayments, long-term borrowing and repayments. And what you're going to notice here is this is negative, this is negative, this is negative. They're paying down debt. We're going to get to this in the bit, but once they pay this down, they no longer have to do it, and all this cash can come rolling right through the equity holders. So it's going to be very interesting. Let's keep going, take a look. By and large, I like what I'm seeing. Now, behind me is our financial statement that we use. This is the template that I give you in the course that I teach at cashflowinvestingpro.com. Let's walk through it and see what we get, right? So this is stated in millions of USD, revenue $8 billion to $8.5 billion, 1% growth annually as an annual CAGR. Super weak, super weak. Technically, it meets our criteria of positive revenue growth. So we're going to check the box, but weekly, right? And what I want you to notice is 8 billion, 8.2, 8, 7.9, 5.8. So it's definitely rocky. I think they kind of fell out of favor a lot, but we're able to come back. And especially with the pandemic, everyone shopping at home, they saw their revenue rise. I also think it's interesting that they tend to be on the lower end of the pricing spectrum. And as inflation is lifting costs of everything, check out the UN's food index. I highly recommend you look at that. UN publishes a food index. It is up 32% year over year. That's food prices globally up 32% in 1 year. So I think what that's going to do is it's going to cause pressure on middle income people that simply can't afford necessarily, this is my theory, the organic stuff that they used to be buying. They're going to have to step down a little bit, and Campbell Soup is a great position for that, for product that they can buy. So you might see a lift here in the future. Who knows? That's speculation, but we're going to go off the 1% just to be conservative. But it could actually, they could gain market share. You never know. Anyways. So it's growing weekly but positive. EBITDA, right? So that's the EBIT that they have in their financial statement, adding depreciation and amortization. Why? Because those are non-cash items. And we're trying to get a P&L line item that represents cash. It's a proxy. It's a poor proxy, but it's a proxy for cash that's on the income statement. So we use EBITDA, and again, it's enterprise. It's the entire company's earnings. It's not earnings per share. I'll explain why later, but this is just EBITDA. So 1.5 billion to 1.8 billion, weak growth, just like revenue, but they're growing in tandem. Margins kept the same. Neither one is growing more or less than the other. Overall, it's positive, it's growing, it checks the box. It's nothing excited about it, but it checks the box. Okay, let's look at enterprise value. Enterprise value, again, as we covered before, is the entire value of the company. And that's what you want to look at. You care about the value of the entire enterprise, not just the market cap. And everybody in the stock market only looks at market cap. And they're missing debt, which is a huge piece of the financial situations right now, especially with interest rates so low. Lots of companies have levered themselves up. And when you talk market cap or stock price, you ignore the debt, which is not right. So debt, speaking of that, let's take a look. $4.5 billion, grew it to almost $10 billion in the mid of this time period, and they've come down to $5 billion. So kudos to them, by the way. Great job, CFO, management team, saying, hey guys, we've got a debt problem here. We need to bring this down over time and execute on that. I like that. So we're going to see if this number is where they need to be or not. But let's keep going. Market cap, shares outstanding times price. I use the average price for their fiscal year end July, average the month of July, each single year, times the shares outstanding in the actual 10K. This is not the 10K, but the 10K, not the current shares outstanding, because it might be split adjusted. You need to go back in time and get that original number with the split adjusted share price. Multiply those two, you get market cap. Market cap's relatively flat, right? Declined slightly 1%. Earnings have grown 1%. So I'd expect the market multiple here to improve in a value perspective, because market cap coming down, earnings going up. I add the debt and the market cap, I get enterprise value. You get the entire enchilada right there. So 19 billion to 18 billion, flat, pretty much. Let's cover debt here. So debt 3 times EBITDA. So what is this? This is saying that the company generates earnings every year and has debt. Earnings are used to pay debt. So if I look at how many years of earnings it will take to pay off all the debt, that is a multiple, that's a leverage ratio, and banks look at that. A bank will underwrite 3 times debt to EBITDA at the senior level. You have to go to other lending institutions to get junior debt, mezzanine, kind of hybrid, preferred, different tranches of debt which have greater and greater risk, higher and higher interest rate, but standard, conservative, first senior secured bank loans will be at 3 times EBITDA, and that's what we use. I'm happy if a company has 3x debt on it. I don't like it if I see 5, 10, 20, 50 times leverage. It's just way too much debt. And it's the debt is the risk of bankruptcy and a risk of a zero return on my investment, and that's not something I'm willing to risk. So 3 times EBITDA, 2.63, 2.82, 6.8. So here, mid-decade, when they hit their $9.5 billion of debt, earnings crater, right? That's the low point in sales, roughly. Low point in earnings. What does that do to the leverage ratio? Jacks up the leverage ratio. CFO's like, uh-oh, I need to do something. Banks are like, you need to do something because I didn't sign up to be over-levered like this, out of spec. So banks, everyone puts pressure, and what do they start doing? They start paying down debt, and they bring the leverage ratio down. They start growing earnings. Earnings grew. Debt ratio came back down to 2.7. Great job, team. Way to bring back the ship. I like that. That's financial discipline. And now what it does is it means that I've checked the box on debt. 2.7 times, perfectly acceptable. You'll also see that the EBITDA, enterprise market multiple, this is our market multiple, one gauge that we use on pricing. It's not the be-all and end-all. You don't necessarily have to buy everything at single digit. You just don't want to pay too much, right? So what this is showing is that I'm seeing double digits for the last decade, and most recently it's fallen in below double digits, mostly because earnings have gone up. Some people are saying it's a one-time blip, so earnings might come down, this might have to go back up, but it does indicate that it could possibly be cheap entry point or reasonable price entry point for us to buy the stock in the future. So that's what this enterprise value to EBITDA also could be considered a payback period, because I'm looking at the enterprise value and I'm looking at how much earnings the whole company makes. And if you look at a price earnings ratio, a PE ratio, right? Price per share divided by earnings per share. This is kind of the same thing, but at the entire enterprise level. So it's not muddied by the share count change year to year. This is the entire company divided by the entire earnings it makes. And right now, this company will generate enough earnings to pay itself off in 10 years. Not bad. So overall, I think this is checking all the boxes. We'll look at the well priced at the end. Let's go look at cash flow. Now we get to the rubber meets the road, the cash flow statement. So this is my favorite statement. To be honest, I just go right to the cash flow statement, because if you can't make cash, I don't want to deal with you. It's that simple. It's too speculative otherwise. I mean, I want a company that produces cash, that can grow, that can reinvest that company cash and grow, and I want it at a reasonable price. It's not that hard of an ask. It's just a very hard thing to find. So here we go. Cash flow from operations. This is the top third of the cash flow statement. I'm just pulling that cash flow from operations line every single year. $1 billion to $1 billion flat. It's saying 3% growth here because I'm using an average for the periods to kind of smooth it out, giving it kind of a CAGR. Because this particular year, remember that pension, the non-cash pension payment, or excuse me, the cash pension payment they had to make brought down the CFO, but it was a one-time deal. So I want to adjust for that. There are really more times. That was 267 million. I add that back to here. I get this 1.4-ish range. So I simply said average this, look at the change over that period of time, and that's how I came up with that CAGR. Roughly 3%. CapEx declining 1% every year, slight margin increase. And then you've got the debt payments. Now, because this is cash, not a balance sheet, all right, so you're going to have positive and negative numbers. Negative means I'm paying down debt. Positive means I'm bringing in debt. And what do we see? Well, we see a giant positive number mid-decade. That's what we said earlier. That's their spike in debt that they had. And then what do? They follow that up with consistent chunking down, big chunks of cash. Look. They made $1.4 billion in cash selling product in 2018. They paid off their CapEx. There's your $384 million. That leaves roughly $1 billion here. They paid down $1.2 billion of debt. So they actually came out of pocket with the cash they had to make up the difference here. And free cash flow to equity was minus $146 million. That minus was made up by cash they had on their bank account. They did the same thing the following year and the following to buy down that debt. And now they're sitting in a position where debt is back to where it needs to be. They're not going to have to make these payments in the future. So going forward might be an interesting opportunity for us. If this $1 billion of debt payment goes away, that means this number is going to be much more in line with the sum of these, and you're going to have more cash that can be used to buy back shares, distribute as dividend, go make acquisitions to grow. That's what we're looking for is free cash flow, and that's why free cash flow is so important. Add these up, I get free cash flow to the equity owners, which is us. That's what we're buying, right? So this is the full enterprise number. I get the share count, and I divide the two. I get per share. Again, here, I think it's noisy because the debt payments, it's not really accurate. It should be in the positive $3 a share range. In terms of share buybacks, they are chewing shares slightly. It's so small that when I round to a single decimal, so no decimal point, I get a 0. So it's a small negative numbers, means they're slowly chewing up shares. But I would expect that to increase when the debt is no longer being bought down. Shares, and then the yield. So the yield here, well, historically, well, not the 16. If you look historically, you're kind of in a 6 to 3 range when debt payments aren't huge. See that? So cash flow from operations, CapEx, minimal debt, positive cash flow from operations, shares outstanding gives me a kind of mid-single digit yield. When I look at last year here, and I just look at this number, and I don't include the debt, divide by the current share count at the $40 price range it's currently, I get a 9% yield. So right now at $40 a share, this is a 9% free cash flow yielding investment without any kind of growth on the top line or margin creep. I kind of like that. It's also higher than we've seen historically, which incidentally corresponds with the lower enterprise value to EBITDA market multiple. Remember, market multiple here you want lower, generally better because it's a payback period. You're buying it number of years you need to wait to get your money back. So you want a lower number. On a yield basis, you want a higher. Yield is kind of like an interest rate. You want a higher yield. So they're kind of inversely related. Lower market multiple, I would expect a higher yield. When I look at it, I'm getting a 9% yield, which is a strong yield in this overinflated environment for a company that has limited debt and has the potential to pass through raw material costs. So I kind of like that. So I would expect a pretty decent IRR on this investment given the low market multiple and the high free cash flow. We look out 10 years, so for us, our IRR is heavily dependent on the cash generated year to year and not so much on what the principal value does, because the stock market's a guess. Nobody knows what's going to do. So the only thing we can do is we can underwrite a conservative forecast that generates cash flow and let the market figure the rest out. Okay, let's now forecast this business. What are we going to do? Well, we're going to pick up on EBITDA. So here we go. EBITDA forecast. I'm picking up on last year's 2021 EBITDA, and I'm going to grow it at 1% annually because that's what they had. That's what they've been doing for the last decade. It's been really flat. I'm not going to give them any kind of price appreciation. I don't know what inflation is going to do, so these numbers are kind of in real terms, frankly. If CPI moves up 5 or 6% in 1 year, which is what we're currently trending for, I would expect Campbell's to be able to push through pricing cost of raw materials to be able to offset that. And that these numbers here are kind of like a real number that they're going to be able to grow over time. I don't know how fair that is. I mean, CPI, for example, over this period of time is probably 2%. So they're growing at 1%. These are all nominal. So they're probably losing 1% in real terms. The same could be said about here, that I'm just carrying forward. If you get a sizable increase in raw material costs, they're going to have to be able to push that through to maintain this. So that's probably some risk here, is can they push through costs? I'd be reading the earnings statements for their ability to do so and watching that closely. But assuming they were able to maintain what they did in the past, either kind of on a nominal basis, I guess not real, on a nominal basis, they were able to continue the path, stay ahead of inflation slightly, or at least close to it. They should get about $2 billion of long-term EBITDA. And I'm applying a 12 times market multiple, so you're getting market multiple expansion. Right now, they're trading at 10x. I'm saying historically they should have a little bit more. So you're going to get a market multiple expansion, which is one of the trifecta that we look for when buying a stock, right? You want earnings growth, you want share repurchase, and you want a market multiple expansion. That's how you get the hockey stock. Check out my video, Domino's versus Google. Go back in the archives. I did it a year ago before people were talking about it. But Domino's absolutely smoked Google as an IPO investment over a 15-year time frame because you could buy Domino's so cheaply when it IPO'd, whereas Google was very expensive. They both performed exceptionally well, but Domino's outperformed because it generated cash flow, they bought back shares, and you got a tremendous market multiple expansion as it IPO'd for single digits EBITDA and now trading at double digits, whereas Google IPO'd in the 20s, it's still in the 20s, so you don't get that expansion. That's a big piece of what we're looking for, going from buying it 10 times to buying it to 12 times. Anyways, so then I get a $240 billion, I get a 20, wait, we've been doing too many big stocks recently. So $24 billion, that's it. $24 billion for a soup company. Less a little bit debt, I just held it constant, gives me a $19 billion market cap out 10 years. Divide that by the 300 million shares currently outstanding. Gives me $63.80 long-term price forecast under this method. Now, if we do this roughly the same thing for the free cash flow method, but one caveat here, I'm only pulling cash flow from operations minus CapEx because I'm holding the debt constant. They're back below 3 times. I don't think they're going to pay off the debt to zero, so they're going to keep it where it's affordable, and the rest of the cash flow can be given to shareholders, can be used to buy back shares, can be dividend, or can be used to buy acquisitions to grow faster than this forecast. Copying the 1% that I had from EBITDA, thinking if EBITDA is growing at 1%, that EBITDA will translate to cash flow from operations, and that should grow at 1%. So it's kind of connected. $3.35 long-term free cash flow. I give it a 5% yield, so it's currently yielding 7. It's going to come, currently yielding 9. It's going to come down over time back to its normal-ish 5, 6-ish range, which means I get $66.90 7 cents as a long-term price forecast for the free cash flow method of valuing companies. Okay, now what do? We have two price estimates for Campbell Soup. I've got $66.97 under the free cash flow yield method. Market multiple, $63.80. I'm going to average the two because I don't know which one to pick. So average, call it $65. $65 out a decade. I can currently buy as much as I want in the stock market at $40 a share. So right there, it's a good $15 of price appreciation that I would expect to get over the next decade. Now let's put it into an IRR and see what happens. So behind me is the rate of return for our investment. So we're going to buy in at $40 a share. Now I'm going to receive this stream of cash flow over the time. And again, it doesn't matter to me if they dividend the money, if they use it to buy back stock, or they use it to go make acquisitions. It's still a pro rata ownership that I own. And if they dividend it out, then I get it immediately. If they use it to buy back shares, then the share count I have in here is overstated. Which means that this number, if you adjust it, would go higher, and I still get that return. Also, if they use this cash flow to go buy a company, an acquisition, that acquisition is cash flow positive. That means these numbers will be higher, the numbers after the acquisition is done. So either way, I will get that cash, and that's why it's very important that you include the cash flows in between the time you buy and you sell a stock. When I net these out, I get a stream of cash flows that I can discount or I can simply do an IRR calculation. Now the IRR calculation is the internal rate of return on my investment. So I bought it at 40, I get this stream of cash flow. When I use an IRR calculation, which is like an interest rate on my money, I get 14%. And that 14% is above market. S&P 500 will do 10% in any 10-year period of time in the history of the market. It averages about 10% a year. I'm saying that's a 40% increase over the market with a 1% earnings forecast growth. That's a great risk reward in my opinion. I also want to comment here on the 14%. Many of you have asked for a net present value calculation or an NPV. What's the difference? Well, some people want to look at the stock at its current value. I look at what I'm going to earn over time. I think it's an easier concept for people to grasp. But you can also consider this as the net present value at which the net present value is zero. So if you punched in, for example, NPV, net present value, and I use a discount rate of 14%, and I use this stream of income, I'm going to get a zero. That means that the discount rate and the internal rate of return are equal to each other. So my net present value is zero, meaning I'm indifferent at that point. But if my required rate of return is 10%, like we use for our stock market, and I can currently make 14, then I'm beating the market, and it's worth considering as an investment. Last thing, if you put in, you're gonna make 2.5 times your money. So you put in 100 grand, you make $250,000 in 10 years. Not bad for a company with low debt and only needs to grow earnings 1% annually over the decade. Not shabby at all. I always do a distribution of return, so it's currently at 40 bucks. If by some chance it should fall, it, in my opinion, becomes an even better price. I think there is risk here that they're unable to pass through everything, or that they just can't grow at 1%. Maybe it's 0.5%, maybe it's zero. Like that is a little bit of risk. But I think you're well compensated at 14% at $40. If it should fall, it gets even better. If it rises, I'd be backing off. I think there's other opportunity out there. But I'm going to give it a good. Why? Let's recap our 5 key attributes. Number 1, top line revenue growth. Yes, 1%. Technically, it's growing. Number 2, EBITDA. Yes, it's growing 1%. Number 3, strong free cash flow. Cash flow strong. Margin is about 14% free cash flow margin. Growth is okay, it's growing, especially when you remove the debt differential like I went through. Low debt, yes, 2.7 times debt to EBITDA. That checks the box. And well priced, yes, it's well priced because under the 2 different valuation methods that we did, we plug in a return that is beating the market. So I would highly recommend that you check out the 1-pager that I am releasing for the Cash Flow Investor Club. This is basically one of almost more than a dozen that I've kicked out in this month of October. I'll continue to do as many as I possibly can. And as subscribers build, I will grow the complexity and the capability of that subscription service. But right now, I'm doing it, just kick it off. Check it out. Cashflowinvestingpro.com is the website. I teach a course if you want to learn how to do it yourself. If you don't want to do it yourself, you can sign up, be a member, and I'll give you the work that I'm going through. It's a great class. I've had really amazing feedback on it. And if you consider yourself an investor, you're young, you have your entire life ahead of you, it's an extremely reasonable price to educate yourself for what could be a 50-year investment horizon. So this has been Campbell's Soup. I hope you appreciate it. Let me know what else you'd like to see for me to review. I've got lots of other stocks that are currently in the pipeline. Check out the comments on the channel. The comments have been amazing. A lot of people recommending tremendous value stocks, and I really appreciate it. I'll try to get the comments, get through the stocks as fast as I can. My name is Cameron Stewart, CFA. This has been Rational Investing. Thank you very much for the time. Take care. Bye-bye.